Erin, is it time to batten down the hatches?
We've been defensive really throughout the whole year, and I think now we're coming into an environment where you're really starting to see the data come out that's continuing to deteriorate, particularly across the globe. So we think now is the right time to be defensive in portfolios. It doesn't mean you have to be completely out of equities, but it does mean that you have to be really diligent about picking your spots within the equity market. So being up in quality, moving out of cyclicals into more defensive stocks. We think that these are the stocks, these are the bellwethers that are going to perform well. And you're seeing it play out in markets. Look at small caps versus large caps. Large caps continue to outperform, and we think that this is, going to continue to predominate, particularly as the data continues to deteriorate.
Yeah. Terry, the administration has thought you could wage a trade war with China and keep the stock market up at the same time. Does something have to give at this point? Is reality setting in?
Well, the reality for the White House, I think, is that when the president was elected, the stock market was at 18, and now it is where it is. And they continue to say, as they have in past volatility patches, that they're prepared for this, and I think they still are. Bottom line is you're going to have an awful lot of uncertainty into negative news out of Washington throughout the rest of the year, not just on trade, where you're not going to get a deal before 2020, even with the move yesterday. But you're going to have more partial government shutdowns. You're going to have all kind of drug pricing legislation moving. You're going to have all kinds of things happening in Washington. You combine that with Brexit and the general softness of the Chinese and German numbers. You're going to have an awful lot of negative news coming out of government channels anyway.
Right. Well, I guess is maybe why, Erin, you're defensive. But look, the stock market can go up with an inverted yield curve, and oftentimes it does. It's not till way later on, many months, if not a year or longer, that you have a stock market actually reacting to that.
Yeah, that's absolutely right. If you look at the data, even prior to 1980, typically you see the equity market go up about 4% in the 12 months post the yield curve inversion. That said, what you do see under the surface is a rotation out of the cyclicals and into the more defensive stocks. And remember, yield curve inversion, first, for it to be a sizable signal, it needs to be inverted for about 3 months. After that 3-month inversion, you typically see within 1 to 2 years on average the economy turn and go into a recession. But it doesn't necessarily mean that a recession is imminent. It still means that you could have some length of economic expansion. We still see the economic expansion here in the U.S. continuing, albeit it's growing but still slowing. And really where you're seeing the pressure is outside of the U.S., and particularly from manufacturing economies that are heavy outside of the U.S. So again, I think that all really plays into this narrative, which doesn't mean you have to be completely selling stocks outright, but picking your spots is important. Being long some of the more insulated domestic sectors that are doing well right now, and being out of the real manufacturing heavy cyclical exposures that have or rely heavily on international trade.
Erin, are you concerned that some of those secular growers and duration-oriented stocks are more of a crowded trade right now? Is that a concern to you if the market does shift?
They absolutely are crowded, and certainly you've seen inflows into those stocks and valuations look rich. But remember, they can stay rich and they can stay and grow, become even more crowded, particularly as this theme plays out. So typically, valuation doesn't necessarily mean the end of outperformance. It typically causes is a catalyst, a shift in risk factors and the factors that are overlying the market. And we're not seeing sort of the conditions in place right now for that to shift. So typically late cycle, you'll see, those duration heavy, more secular growers grow more and more and more expensive up until really the start of the recession. And we still see, particularly in the U.S., a recession, 1 year out, so or more. So we're not calling sort of the imminent end of this sort of secular growth stories and growers that are going to continue to outperform.
Yeah, Terry, Bank of America today says the trade war is going to last indefinitely, and they expect an escalation in the currency fight. How do you see it? Do you agree with them?
Well, I've been calling no trade deal for calendar year 2019 all year. So I'm going to immodestly say I've been ahead of the curve on this. I see no end to this, but the thing to look for, the sweet spot, is if China is willing to accept an enforceable deal. If it is, it will have a deal. But without an enforceable deal, the United States is not going to yield on this. Number one. So I don't see an end to the trade war. And I continue to see potential escalation in currency. China makes the move it made last week. That's not the only time that they will try to pull that particular lever. And I think that's a reminder of that they're not without tools. Fundamentally, I think it is in the interest of the United States and China to pretend to continue to talk and pretend to make progress for a while, because that helps calm markets a little bit. But I don't see any breakthroughs here for quite a while.